The Little Book of Common Sense Investing by John C. Bogle, the founder of Vanguard Group, is a practical guide that advocates for index investing as the most reliable and effective way for individuals to build wealth over the long term. Published in 2007, Bogle distills decades of financial experience into straightforward advice, urging investors to adopt a simple, low-cost strategy that focuses on long-term results rather than short-term speculation. Key themes and concepts. The case for index funds. Bogle argues that low-cost index funds outperform actively managed funds over time. Index funds track the performance of the broader market, such as the S&P 500, and provide diversification by holding all the stocks in the index. By avoiding active management fees and trading costs, index investors keep more of their returns. The arithmetic of investing. Bogle introduces the concept of gross returns versus net returns. Gross return, the market's total return. Net return, what investors actually receive after costs, including fees, taxes, and expenses, since markets are zero-sum games. One investor's gain is another's loss. The high fees of actively managed funds make them mathematically likely to underperform index funds. Costs matter. Bogle repeatedly emphasizes the destructive impact of fees, expenses, and taxes on investment returns. Over decades, even a 1 to 2% annual fee can erode a significant portion of an investor's wealth. By choosing low-cost index funds, investors minimize these expenses and maximize long-term growth. The folly of trying to beat the market. While active fund managers aim to beat the market, most fail over time due to high costs like management fees and trading fees. Poor timing is another issue. Managers often buy and sell at suboptimal times. Bogle shares data showing that only a tiny fraction of actively managed funds consistently outperform the market over long periods. The power of compounding. Bogle explains how compounding returns, reinvesting earnings over time, is one of the most powerful tools for investors. The key to harnessing compounding is to start investing early, stay invested for the long term, and avoid unnecessary costs and fees that hinder growth. Diversification and risk management. Index funds provide instant diversification by spreading investments across a broad range of companies and sectors. This diversification reduces risk and increases stability, especially for individual investors who may not have the knowledge or resources to select individual stocks effectively. The investor's worst enemy, themselves. Bogle identifies behavioral pitfalls that harm investors, such as chasing hot stocks or funds, panic selling during market downturns, trying to time the market. He encourages investors to adopt a stay-the-course mindset, invest regularly, ignore short-term noise, and focus on long-term goals. The historical evidence for indexing. Bogle backs his arguments with historical data, demonstrating that over 90% of actively managed funds underperform the market in the long run. Index funds consistently match market returns and beat the majority of actively managed funds due to their lower costs. Simplicity is key. Bogle advocates for simplicity in investing. His strategy boils down to buy low-cost index funds, hold them for the long term, and ignore short-term market movements. By avoiding complexity, investors can reduce stress, save time, and achieve better results. Focus on the long term. Successful investing requires discipline, patience, and a long-term perspective. Bogle warns against short-term speculation, trading, or trying to beat the market. Instead, he advises investors to focus on the enduring growth of the economy and corporate profits over time. Key takeaways: invest in low-cost index funds. Index funds deliver market returns, which outperform most actively managed funds after costs. Minimize costs, fees, expenses, and taxes significantly reduce long-term investment returns. Keeping costs low is crucial. Don't try to time the market. Market timing and stock picking are speculative and often unsuccessful. A passive, consistent approach works best. Stay diversified. Broad market index funds provide diversification, reducing risk. Compounding is powerful. Start early, invest consistently, and let compounding work for you. Ignore market noise. Focus on long-term goals rather than reacting to daily market fluctuations. Stick to your plan, develop an investment plan, and stay disciplined, even during market volatility. Bogle's recommendations for investors. Invest in low-cost index funds, like those tracking the S&P 500 or total market indexes. Avoid actively managed funds due to their higher costs and underperformance. Reinvest dividends to maximize compounding. Keep investment strategies simple and avoid unnecessary complexity. Take a long-term perspective and avoid emotional reactions to market swings. Who should read this book? Beginner investors, those looking for a simple, proven strategy to build long-term wealth. Experienced investors, individuals seeking to refine their strategies and minimize costs. Financial enthusiasts, anyone interested in understanding the benefits of passive investing. Final thoughts. The Little Book of Common Sense Investing delivers timeless advice. By investing in low-cost index funds and staying the course, investors can achieve market returns and build wealth over time. Bogle's principles are grounded in logic, historical evidence, and a deep understanding of human behavior, making this book an essential guide for investors at all levels. Hit the like and subscribe.